Hello again, RoyZesch.REALTOR here with Coldwell Banker Legacy in San Angelo. Today I want to talk to you about mortgage insurance. Mortgage insurance is one of those things that can sneak up on you in the transaction process, and you pay a lot of extra money over the life of your house and not even know what it's really going on, because it's really something you can't control other than by having a larger down payment, as we'll talk about in a little bit. So what is mortgage insurance and how did it start? Well, years and years and years ago, when people bought a house, they came in with a large down payment, 15, 20, 25, 30%, maybe 50%, and they financed it for very short periods of time, 10, maybe 15 years. But as houses got more and more expensive relative to people's income, then they had to get longer and longer terms on the mortgages. The other thing that happened with that is they were less and less able to come up with the large down payments. So finally, to be able to get by with a smaller down payment, and today you can buy houses literally with zero down, or really 2 to 3% down is pretty easy to do. So what the lenders did to protect themselves is they invented mortgage insurance. So basically what the lender does is, if you're buying a $100,000 house and you are not able to put down at least 20% of the value of that house, or $20,000, then they will buy mortgage insurance. Now, they buy it to protect them, like any insurance, but you end up paying for it. It's rolled into the cost of your loan. So they buy insurance to protect them from the risk, because there's a lot more risk with loaning you $100,000 to buy a $100,000 house than there is with loaning you $80,000 to buy a $100,000 house. Because then if you default, then they can take back the house and are more likely to be able to sell it and get themselves back whole. So they did this, and it helps you to be able to get in with a smaller down payment, but it also costs you, because for at least until you're down below a 20% value, loan to value, you're going to have to pay that mortgage insurance, and in some cases you'll keep paying it for the life of the loan until you refinance or something. So what can you do about it? Well, the simple answer is save more money. If you can save 20%, then you don't have to worry about mortgage insurance. It will never be a factor. But that's difficult, and it's particularly difficult on a first house. So you're looking at having to save, if you want to buy a $100,000 house, then you got to save at least $20,000, plus you're going to have some additional closing costs and other things going in. So you're looking at really needing to have, say, $25,000 in the bank before you're ready to buy your first house. And that's difficult to do. It can be done with diligence and perseverance, but it's difficult. So the other option is, okay, on the first house, say, we're just going to have to do this, and go into the process knowing you're going to have to do it, and work to pay down your loan amount as quickly as you can. So once that loan amount is below 80% of the value of the house, whether the value of the house goes up or the value of the loan goes down, either one, that will make that come into effect, and you can get it removed. Either get it removed, in some cases it's removed automatically once you get below a certain percentage. So how much does mortgage insurance cost you? Well, it varies depending on the credit scores of the borrowers and things like that. It can range somewhere in the vicinity of $30 to $70 a month per $100,000 of loan value. So in that same $100,000 house, it could be as much as $70 a month. And that's $70 a month that is not going to pay down your note. It's not going to interest. It's not going any place that you're going to get any benefit out of it. It's only going to pay this mortgage insurance. So that's why that's a substantial amount of money in a house like that. So, then you're talking as much as 10% of your payment every month is mortgage insurance. So be thoughtful about it, and particularly as you grow in house size, as your house needs get up, your income increases, your stability goes up, you're buying new houses, just keep that income. If you go to sell a house and you have equity built up in it, don't necessarily take the equity out and buy a nice car because, hey, we've got equity in this house. And that's a good thing. Take it and roll it into the next house, so that is your down payment. What you made in profit on this house is a down payment going to the next house, and so you can eliminate that mortgage insurance. Then you can take that money that would be going to mortgage insurance, save it, pay down the house, and then you'll be able to quicker afford the new car and those other things. So it's one of those growing up, maturing things, and just realizing that if you go to just the max you can do on a house, that it's gonna stretch you, and there's gonna be some additional expenses that'll make it even more difficult for you. But if you're willing to take the time to save before you go into it, or during the process of house 1, house 2, house 3, as you grow into different houses, then it's after a couple of houses, it's not too difficult to do it. So don't go to the maximum is basically my suggestion, and that work toward getting where you don't owe more than 80% of the value of your house, and so you eliminate that mortgage insurance expense, and that money is able to go into your pocket or to other priorities that you're going to have at those stages of life. So again, mortgage insurance is one of those things, a lot of people pay it, a lot of people know they paid it, they heard the term somewhere, they just really don't know how it works. So I wanted to kind of go into a little bit of explaining how it works so you know the process, and just to set your goal to get to a point where you're not paying mortgage insurance. If you have to on the first little bit, that's fine. Some people, you just have to start somewhere. But to really focus your financial attention to get to the point where you don't have to pay it for the rest of your life. Because that's a lot of dollars in your pocket over the course of 30, 40, 50 years of owning homes. So that's all for today. RoyZesch.REALTOR, 325-268-0775. Thank you.